Imagine that insurance is this. Insurance is a contract, right? A contract in which you have terms and conditions. We already saw in previous classes in economics what a term and a condition is, right? The things that you should follow, the things that are your rights and your responsibilities to keep that contract alive and represented by a policy. What's a policy? It's basically everything that includes or that it is included on the insurance contract, in which an individual or an entity receives financial protection or reimbursement. What is reimbursement? Is basically that you receive a quantity of money that is equivalent to the quantity of money that you lost either on goods or services. For example, if you have car insurance, you have seen before that the insurance company is going to pay you an amount that is relative either to the damage that the car suffered or either relative to the repair that the car will need later on. In this case, we're talking about the financial protection of people. Why? Because there are many things in life that are expensive. Just imagine a car is too expensive. A house is really expensive. Your health is something that is really expensive when it starts deteriorating. And what happens is that an insurance is a way that you make sure that you can keep on counting with those resources, even though something bad may happen, okay? So that is the definition. But right now we're going to talk about insurance policy components, okay? The main components of an insurance. The first one is the premium. And a policy's premium is its price, okay? How much does it cost? Typically expresses a monthly cost. So that means that the premium is the amount of money that people is going to pay in each month to make sure that they have all the benefits for the insurance policy. So in this case, the premium is determined by the insurer based on your business risk profile, which may include credit worthiness. What is the business risk profile? Okay, when they make an insurance contract, they make sure to have like an interview with the person that is going to be the insurer. Why? Because they need to know that person. They need to know the record that this person had. Imagine that you are a person that likes drinking a lot. And according to your credit, to your story, you have the problem that you have been part of 4 car crashes. All of them because they were related to alcohol and things like those ones. Since you were part of those car crashes, therefore you have them in your record, and then the insurer may say, okay, this person is somebody that drives careless, that is always driving in these conditions or doing this in these conditions. Therefore, we're going to sell him an insurance that is going to be more expensive than the one of a person that drives carefully. Why? Because he is more prone to use it because of the misbehavior that he has. Therefore, he has to pay more. As someone that is careful on everything that they do, they won't need to pay a lot of money in that regard because they are not going to use it that much. Then we have the policy limit. That is the maximum amount of money that an insurer will pay under a policy for a covered loss. Imagine that your house one day gets, well, not your house. Let's not be so detrimental. But imagine that a house of somebody gets in fire, right? They have a big fire over there. And then he has a policy for home insurance that says that the insurer can pay over $100,000 for the repairs or for the price of the house. And probably the repairs of the house, they do not cost $100,000, but they cost more than that. They cost probably around $120,000, $130,000 or more than that. In that case, the maximum that a policyholder can pay is $100,000. Even though they cannot pay for everything, but they can give you a big amount that is going to help you out to either buy a new house or to pay for all the repairs and things that are needed. Then we have the deductible, that is the specific amount of the policyholder must pay out of pocket before the insurer pays the claim, okay? So in this case, we're talking about the deductible. Imagine it like this. Imagine that 2 persons are in a car crash, okay? And let's say, let's call this person Jaime for saying something. Jaime is the one that caused the accident. Therefore, before the policy company can repay all the money for the accident, they have to pay first a certain quantity that is the deductible that they have available at any moment if the insurer claims it. Okay, like for example, you hit the other person's car and then you want to pay for the repairs of that car. Therefore, the insurer is going to give you, okay, we have this amount available for you to pay for that problem. And then we're going to make the calculations to pay for everything. Those are the three components. So remember, premium, that is basically the amount that you pay monthly, that it can vary depending on the kind of person that you have. The policy limit, that is the maximum amount of money that people can pay or the insurance companies can pay for any kind of situation, and the deductible, that is the amount of pain that can be paid at the very first moment when something bad happens. So let's continue. So we're going to talk about some of the types of insurance that we have seen before. For example, we have the following. What is car insurance? An auto or a car insurance is a policy purchased by vehicle owners to mitigate costs associated with getting into an accident. What is the word mitigate doing over here is really important, because the word mitigate means to reduce or at least to make less painful the cost of everything. It doesn't mean to pay for everything, absolutely, but just to reduce the amount of money that the person involved in the accident will pay. In this case, instead of paying out of pocket for auto accidents, people pay annual premiums. We already saw what a premium is, right? That is the premium, the amount of money that you pay monthly. In this case, when we're talking about car insurance, people pay them annually in some of the cases, or there are some other plans that will allow you to pay monthly. But depending on how much you pay, that's the type of insurance that you have. Something that I want to make clear and sure for you is that insurance has different tiers, okay? That means that the more you pay, or the better the insurance that you buy, the better the benefits you will have access to. Therefore, to an insurance company, the company then pays all or most the costs associated with the auto accident or the vehicle damage. But I want to make something clear is that an insurance company or a policy company, they are not going to pay a certain amount because you want them to or because you tell them. First, they do an investigation. And what do they do in the investigation? They determine the cost of the repairs for the cars involved in the accident. They determine how much is considered on damage over the restock. So that means the repair parts for the cars, how much the mechanics are they going to ask for, the price, even the price of the car. Because sometimes they take into consideration the type of car and model that you are driving to make sure that they can pay like probably an equivalent amount to the price of the car. But not the real amount that you buy it for, by the amount that it is really worth. Remember that we talk about this one, this term that is depreciation. And it's basically when you have a good that over time is going to lose its value because new models are arriving or new things are being invented. So what the auto insurance includes is the three following things. In exchange for a minimum premium, the insurance company agrees to pay your losses as outlined in your policy. Coverage includes property, damage to or theft to your car. Like for example, if you are in a place, like imagine you go to a certain place, imagine you travel to San Salvador one day by car. And when you travel over there, the problem is that you are in the car, yes, and then you decide to park in a specific place. And when you park in that specific place, the problem is that you go back later to your car and the window is broken, okay? The windows are broken and the CD player is stolen. In that case, since your car receives some damage because the windows are broken, then you call your insurance companies and tell them, you know, this happened to me. I need you to come over here and check it out and see if you can repay me back for this. The purpose of this is to make sure that you are protected in these kind of situations. Also, if somebody steals your car, if somebody steals your car, you will listen to people that they have car insurance, that they will tell you, okay, if somebody asks me for my car, if they want to steal it, I will give it gladly. Why? Because I can just call my insurer, tell them, okay, somebody stole my car. Can you please repay me the money so I can buy a new one? And they will do so. But that will depend as well on how much money they can give you, the conditions your car was in, and also the different premiums that we discussed at the beginning, that depending on the type of driver that you have. Then is liability. Legal responsibility to others for bodily injury or property damage. Like if you are in a car crash and you are the one who caused the car crash, and you hurt somebody that was driving the other car and that person ends in the hospital, then it's your responsibility to pay for the medical bill of that person. But your insurer is also in charge of paying for that. So that means that they ask for the medical bill of the person involved, and they say, okay, we will give this amount of money to that person to recover or to pay for the medical process. We have the medical insurance, that is the cost of treating injuries, rehabilitations, and sometimes the lost wages and funeral expenses. So even if a person that is involved in an accident is killed or passed away because of this, then they can even pay for the funeral services if that is needed, okay? Or rehabilitation if somebody is in a really big problem and they have to recover from this kind of accident. Now we're going to talk about health insurance. That is an insurance that protects you and your family against financial calamity. As you see already, financial calamity. When you become ill or incapacitated. I want you to imagine this, right? You are working in a place that is kind of dangerous, and one day you have an accident. And from this accident, probably you end up in a wheelchair. Therefore, you cannot continue going to work because you are not able to accomplish all of the functions that you used to have because of your condition. Therefore, what the insurance companies will do is that they will be giving you monthly an amount of money so you can support yourself because you're not going to be able to work as you used to work. For example, there are many ways to learn about these kinds of coverage. We're going to, you probably, if you have done the homework assignments, you have read some of them in the articles that I posted on you. But basically, in short, so to not bore you and to not make this an hour-long class or more, I will tell you that probably what they cover is that you become ill, incapacitated, that you have an injury, that you have something that you need to recover. And there are many, many different types of health insurance that they cover different types of things. For example, there are insured that they may cover even your funeral expenses and also that you passed away. When you passed away, they can even give some amount of money to the people in your family to make sure that they can recover at least financially, but not emotionally from this hit. But what is private health insurance? There are two types of insurance, and what is the difference between normal health insurance and private health insurance? In the case of normal health insurance, is one that is given by the government. In this case, we're talking about if we apply it to our country, it will be the Seguro Social, right? The EASE. That will be considered the health insurance that everybody gets. But when you buy private health insurance, that means that you buy it yourself. Nobody is providing it for you, but somebody is paying for it. Like, for example, you go to a company, to an insurance company and say, okay, listen, I need insurance, I need protection because of this and these circumstances. Therefore, if you are an employee and you don't have a medical insurance at your job, you cannot to buy one of these ones. Even banks, some banks here in the country, they may offer this kind of insurance to many people to make sure that they can have something to support them when they have either a disease or an accident. So you see that over here, that's why we say that instead individuals and families buy these policies directly from insurance companies. There are some companies that are completely bold to sell insurance to you. So over here, you see that a family can afford a health insurance. But how? If you're a parent, for saying something, and you say, okay, I want to buy some health insurance, but I don't want it just for me, but for everybody, either my kids, my wife, and for everybody in my family. So no matter what happens, they will be covered. And then they can give you a certain plan that is like a little less expensive, but it's going to cover all of your expenses for everybody in the family. So this is something that all health insurance offers. It doesn't matter if it is private or public. First thing that it includes is the payment for medicine and treatments. So everything that you need to pay, like for medicine, if you have to buy certain medicine that it costs $100 or probably it costs $20, $40 and you have to pay with your own money, therefore the health insurance is going to cover it. They're going to tell you, okay, you present the bills of the different medicines, and when you present them, Then you come back to us, you showed us the bills, and then we're going to give you the money back, or the treatment as well. The treatment, and remember that in the public system, it is completely free. But in the case of private system, if you go, for example, to treatment to Centro Médico, they are going to charge you a bill, and they ask for really pretty money for you to be using their services, right? So you have the bill, you take it to the bank, or you take it to the policy company that you are affiliated with, and they are going to repay that money back to you. For surgeries as well. Like, for example, if you have to go through an emergency surgery and you don't have the money to pay for that, they are going to give you the means so you can pay for it later and you can go through the process without any inconvenience. Like, there are some surgeries, remember that they are really expensive. Probably a surgery, it's normally around $2,000, $3,000, even $10,000, depending on the kind of problem that you may have. Injuries by accidents, not caused by the insurer. So that means that it is an accident that is not caused by yourself, but an accident that is caused by a third person. Like, for example, you were in a car accident, or you were crossing the street and somebody crashes on you. Therefore, you are not the one who caused that accident, but you were the one affected by it. Therefore, you can get an insurance payment for that situation. Hospitalization costs. Obviously, if you are going to be hospitalized for any reason, either for a disease, for a surgery, for an accident, there are some places that they will ask you for a lot of money to have you there, because they are going to charge you for using the lights, for using the bed, for using the bathroom, for giving you food, for giving you the medicines that you need, for giving you treatment, etc. Therefore, the insurance can even cover those costs to make sure that you can avoid that financial hit later on. Medical appointments, like, for example, you are with a doctor, a private doctor, and they tell you, okay, I want to see you again in 2 months, okay? And then you go 2 months later, and then you have to pay back again. They cover that as well. Dentists of doctor checkups and follow-ups. In that case, even in the dentist, you go to the dentist because you have a molar that has a cavity and you have it fixed. In that case, even you can go to your insurance company, present the different bills, and in that way, they are going to repay you back. And any type of medical bill. Any type of medical bill that you have, either if you go for some medicine, either if you go for an appointment, either if you go for anything that they ask you money for, therefore you can present these, so make sure that the insurance company can give you the money back. Now we're going to talk about property insurance. That is a broad term for a series of policies that provide either property protection coverage or liability coverage. Liability means financial coverage for property owners. In this case, property insurance is broad because it covers many different types of property. It is individual properties or public properties. Like, for example, if you are the owner, for example, of a chain of restaurants, therefore they can cover all the chain that you have with this kind of insurance, or you can just cover your house. That will depend on the type of reason why you need this kind of insurance. Property insurance provides financial reimbursement to the owner or renter of a structure if its contents, in case there is damage or theft, or to a person than one another, or rented that person is injured on the property. Like, for example, in the case of damage, we're talking about like there is an earthquake, okay, and part of your house crumbles and falls apart. Then in this case, the insurance company can pay for a little bit of that repair. Another case of an accident like this one can be a fire, as we discussed before, that can be causing your house, and therefore you need to repay everything. Therefore, they can offer you some money to pay for the damage. A thief, that, for example, a thief enters to your house and they break in and they take some of your valuable possessions, that can be covered as well for your property insurance. Why? Because they entered to your property and they took things that were part of the property as well. And finally, to a person or the owner or renter that is injured on the property. Like somebody gets into your house, they break in and they stab you, or then they shoot you and you are injured in your house, that will be covered as well with this kind of policies. Okay, let's continue. So when we talk about property insurance, we have how property insurance works, okay? Perils covered by property insurance typically include select weather-related afflictions. What is a peril? We're talking about situations, okay, or accidents. that are covered by this kind of insurance. They cover weather-related affliction, either a thunderstorm, either a regular tornado, well, not a waterfall, but a rain, or a flood, or any kind of environmental accident that you can imagine is covered with this one. So for example, you see over here, we have damage caused by fire, smoke, wind, hail, or the impact of snow, ice, lightning, and more. All of these are covered by property insurance because they are things that are not under control. And when they happen, we want to have some type of, how can I tell you? Some type of certainty that things are going to get better because you lost all those material possessions. Property insurance also protects against vandalism and theft, covering the structure and its contents. This is related to the point that we saw just a couple of minutes before. Vandalisms, we're talking that somebody breaks the window, somebody paints a graffiti, somebody tries to break one of the walls, etc. And theft, like somebody gets into your house and they try to steal something that is part of your regular possessions, like a computer, a TV, etc., etc., all of those stuff. As well as covering the structure. Why the structure? Because imagine that the structure is compromised. What do I mean by this is like the things that support the house, they crumble and they go down. And then understanding property insurance, these are the three things that we need to understand. I will explain it as fast because we just have 3 minutes left, and let's see if we can get on to your life insurance. Replacement cost, that is cover the cost of repairing or replacing the property at the same or equal value. The coverage is based on the replacement cost values rather than the cash value of the items. Replacement cost, that means that how much is going to cost to get a replacement for the things that you used to have, okay? Like it is going to be less expensive to get, like for example, a sofa that is not that expensive, but they can pay it for you, or like getting some kinds of windows that are less expensive than the ones that you have. In that case, that's why they want to make sure that they have at least the same value for everything that was in the house. Actual cash value, coverage pays the owner or renter the replacement cost minus depreciation. So that means that they lost the value that they had over time because they were used or they were stopped being new. If the destroyed item is 10 years old, you get the value of a 10-year-old item, not a new one, okay? This is important. So if you have been having like a certain item for a long time, they will depreciate the value of that item for the amount of time that you have. Therefore, if you buy, for example, a TV for $500 and you had it on your living room, but that TV was from 2 years ago, therefore they are not going to pay you over the real price that you pay for that TV, but the price minus the 2 years of usage. Extended replacement cost, they will pay more than the coverage limit if the cost of constructions have gone up. Like for example, if you live in a place in which there has been a big proliferation of businesses or different properties, that means that the prices will go up. Therefore, your property will go up in price as well, and they will take that into consideration as well. Then we have life insurance. That is a contract between the insurer and the policyholder. That is the topic that we are studying right now, in which the insurer guarantees payments of a death benefits to named beneficiaries when insured dies. What does this mean is that, for example, if you buy life insurance, you are a person that believes that someday in the future you may use it. Therefore, you have some beneficiaries that are people that will receive certain money after you die, okay? In this case, normally they ask you to choose a person that is the closest to you, either your wife, your kids, your mother, your father, etc. But what they do is that they say, okay, if you passed away, then this person is going to receive this amount of money. And you can divide it on even parts. You can give more to one person, less to another. It depends on you. The insurance company provides a death benefit in exchange for premiums paid by the policyholder. The death benefit is the amount of money that they will receive after that person that has this kind of policy passed away. And the premiums is the amount of money that people is going to be paying monthly for this kind of insurance. Life insurance includes the death benefit that we discussed already what that is, the premiums, and the cash value. The cash value, that it means the amount of money that people can use for different types of situations. And with that, We finished the topic right now, and we have catch up to the place that we are right now, that is life insurance. Next week, we're going to start talking about the other types of insurance that we have already on the next activities. So I hope that this video is helpful. Right now, we have 6 more or less minutes left. So right now, I will give you permission to activate either your microphone or your camera if you want to use it. I will stop recording from this moment on, so I can solve any of the questions that you may have right now, okay?